On September 15, 2008, Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It triggered the most severe financial crisis since the Great Depression. With over $600 billion in assets, Lehman's collapse wasn't just the failure of another investment bank, it was a global catastrophe that exposed the vulnerabilities of modern finance. The effects rippled across markets, wiping out trillions of dollars and forced the US government to intervene in the financial crisis. But how did one of the world's most prestigious financial institutions go from prosperity to complete bankruptcy? Why wasn't it saved by the US government when other banks were bailed out? If Lehman would have been saved, would it have lessened the effect on the 2008 crisis? We will find answers to all these questions in this video. To understand this, we need to go back to the early 2000s when Wall Street was booming, real estate seemed unstoppable, and the seeds of destruction were quietly being sown. At the turn of the millennium, Lehman Brothers was thriving. By 2000, the firm had established itself as a dominant player in the global financial markets. It focused on investment banking, fixed income trading, equity, and asset management. Lehman had survived the 1998 Russian financial crisis and the collapse of long-term capital management, which had destabilized financial markets worldwide. This survival fueled the firm's confidence, prompting it to explore new avenues for profit in the early 2000s. Lehman, like many other Wall Street firms, began pouring money into the booming housing market. They aggressively expanded its mortgage securitization business and acquired mortgage lenders such as BNC Mortgage and Aurora Loan Services, which specialized in subprime and high-risk mortgage products. Lehman also became one of the largest underwriters in mortgage-backed securities, packaging thousands of mortgages into tradable securities. Between 2003 and 2007, Lehman's mortgage-related securities portfolio grew exponentially. It was a significant portion of its revenue. During this period, Lehman generated billions in profit, with its stock price surging to an all-time high of $86 per share in February 2007. At that time, the firm seemed unstoppable. Lehman's strategy was simple: capitalize on the booming housing market by issuing, packaging, and selling mortgage-backed securities. However, the firm's aggressive expansion into subprime mortgages and risky real estate ventures exposed it to unprecedented levels of risk. By 2006, Lehman's real estate holdings had increased to over $100 billion, making the firm highly vulnerable to any downturn in the housing market. Despite warning signs that the housing bubble was beginning to burst, Lehman doubled down on its real estate investments. Richard Fuld, Lehman's long-serving CEO, was a strong believer that the firm's position was strong enough to weather any storm. Fuld, who had led Lehman since 1994, was known for his aggressive leadership style and an unwavering belief in Lehman's resilience. Under his leadership, Lehman's appetite for high-risk, high-reward ventures only grew stronger. By mid-2007, the U.S. housing market was in trouble. Home prices had begun to fall, and defaults on subprime mortgages were rising. In June 2007, Bear Stearns, another major Wall Street firm, announced the collapse of two of its hedge funds that had invested heavily in subprime securities. This was the first clear sign that the subprime crisis was spiraling out of control. Despite these warnings, Lehman continued to reassure investors that its exposure to the subprime market was manageable. In fact, the firm increased its exposure to mortgage-related assets, believing the market would stabilize. By late 2007, Lehman was sitting on a mountain of deteriorating assets, but the true extent of its exposure was hidden behind complex accounting maneuvers. Lehman used an accounting trick known as Repo 105. It was an accounting technique used by Lehman Brothers to temporarily remove billions of dollars of assets from its balance sheet, giving the illusion that the firm was healthier and less leveraged than it actually was. This practice played a significant role in misleading investors and regulators about the true state of Lehman's financial health in the months leading up to its collapse in 2008. How Repo 105 worked. A repurchase agreement, repo, is a form of short-term borrowing where a financial institution sells securities, such as bonds, to another party with the agreement to repurchase them at a slightly higher price after a short period. Let's see an example of how Repo 105 works. Let's say Lehman Brothers had $50 billion worth of risky mortgage-backed securities on its balance sheet. These MBS were losing value as the housing market collapsed, and Lehman wanted to temporarily reduce its reported debt. So, Lehman sold $50 billion worth of these securities to another bank, such as a European bank. The sale was structured at 105% of their value, which meant the accounting standard required to classify the deal as a sale rather than a loan. So for this transaction, Lehman received $47.6 billion in cash from a European bank and reported the deal as a sale of MBS rather than a loan. This removed the $50 billion of risky assets from its balance sheet. As the quarter ended and when Lehman's financials were reported to the public, then Lehman would repurchase the securities at 5% higher cost for $50 billion, bringing the debt back onto its balance sheet. As the financial statements for the quarter had already been published and Lehman had successfully cleaned up its books for that quarter, by removing liabilities from its balance sheet at critical reporting periods, Lehman misled investors and regulators about its true financial condition. This gave the false impression that Lehman was more solvent and less risky than it actually was. As 2008 began, the global financial system was on the brink of collapse. Lehman's losses increased exponentially as the housing market continued to deteriorate. In the first quarter of 2008, Lehman reported a profit, but by June, the firm posted a $2.8 billion loss. It was its first quarterly loss since going public in 1994. This was followed by an even bigger loss of $3.9 billion in the third quarter of 2008. As Lehman's situation worsened, the firm was desperately looking for a buyer to rescue it from collapse. Fold and Lehman's management approached numerous potential buyers, including Bank of America and Barclays, but none were willing to acquire Lehman's massive liabilities without government assistance. In mid-September 2008, U.S. Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, and New York Federal Reserve President Timothy Geithner convened a series of emergency meetings with Wall Street executives to try and broker a deal to save Lehman. However, unlike in the case of Bear Stearns, which had been bailed out by the government earlier that year, Henry Paulson was adamant that no public funds would be used to rescue Lehman Brothers.
You did it for Bear.
We are not bailing out Lehman. Wall Street has a gambling problem. The government keeps covering their losses. They never learn anything.
Bank of America was initially interested in acquiring Lehman, but instead, it opted to acquire Merrill Lynch, leaving Lehman without a lifeline. Barclays expressed interest, but ultimately backed out due to regulatory concerns and the lack of government support. Barclays wanted to save Lehman and asked Warren Buffett to cover the costs for a while, but they couldn't have proper communication at the time as Warren Buffett was traveling and the deal couldn't go through. So, on the morning of September 15, 2008, after a weekend of frantic negotiations, Lehman Brothers filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy in U.S. history. Lehman had $639 billion in assets and $619 billion in debt. The collapse sent shockwaves through the global financial system, triggering a panic that led to the worst financial crisis since the Great Depression. Lehman's final days were marked by chaos, desperation, and moments of high drama. Employees who had been making millions of dollars in bonuses just a year earlier found themselves out of work overnight. The sight of Lehman employees leaving the building with cardboard boxes became one of the defining images of the crisis. Lehman's executives had no viable rescue plan. They used to joke that, "We're on the Titanic and it's hitting the iceberg." The remaining employees at Lehman continued working even as the firm was collapsing around them. The bankruptcy not only wiped out Lehman's shareholders, but also led to the freezing of global credit markets. Money market funds, which had been considered safe investments, suffered losses, ultimately leading to a loss of confidence in the financial system. Lehman's failure also exposed the vulnerabilities of other major financial institutions, including AIG, which required a massive government bailout to prevent its collapse. Just a day after Lehman filed for bankruptcy, on September 16, 2008, the government bailed out AIG by giving out $85 billion. Now, you might be wondering if the government saved other financial institutions like AIG, which was in deep trouble owing $440 billion in credit default swaps. Then wouldn't it have been possible for the government to save Lehman Brothers? The Dow Jones fell 500 points when Lehman's bankruptcy was announced. But had the government saved Lehman, would the financial crisis have been severe? This is also one of the questions many economists ask the government. If they saved other banks, why did they not save Lehman, which was possible? Investors like Warren Buffett say that if the government wants to do something, then it can do it.
Whatever the Fed thinks it can do, it can do.
In many interviews, Paulson and Bernanke said that they couldn't save Lehman because they were not sure how much of the toxic assets Lehman was holding, and also the mismanagement of Lehman's books and records using Repo 105 was found in the year 2010, long after the crisis happened. But at the peak of the crisis, the government underestimated the consequences of letting one of the biggest investment banks fail. Not only did it cause huge problems, but it also worsened the crisis. There is also a book written on this topic titled The Fed and Lehman Brothers by Lawrence Ball. The book mentions many of the compelling arguments that Lehman Brothers could have easily been saved. You can find the link to the book in the description. One of the official narratives the government gave was that Lehman's did not have enough collateral and was insolvent. But Lehman had enough assets exceeding its liabilities. These assets could have served as collateral. If you look at the broader picture, the collapse of Lehman Brothers looks more like a political unwillingness to resolve the issue than the actual issue. Just before Lehman, the government had rescued Bear Stearns, and just a day after Lehman Brothers filed for bankruptcy, the government provided $85 billion to AIG. The $85 billion was just the first installment. The total bailout cost for AIG was about $182 billion. Lehman had around $620 billion of debt. But when the government bails out a financial institution, it doesn't pay off the firm's entire debt. Instead, it typically provides liquidity assistance or guarantees to restore market confidence to prevent panic.
Looking at the asset valuations, we had strong capital. We had lost $30 billion of liquidity in 2 days. There's another claim, we had no collateral. We had plenty of collateral, as evidenced by the fact that on that Monday, we put up $50 billion of collateral to get a loan from the New York Federal Reserve Bank, all of which, by the way, was paid back 100%. So we had collateral, we had capital. We did not need a capital bailout. We needed a liquidity bridge so that we could consummate the sale to a potential buyer. That is what we needed.
The Federal Reserve could have provided emergency funding to Lehman to avoid bankruptcy. Many analysts estimate that the bailout for Lehman might have cost somewhere between $50 to $75 billion. This amount would have been used to stabilize the firm, provide liquidity, and potentially facilitate its acquisition by another institution like Barclays or Bank of America. If the US government had decided to save Lehman Brothers in September 2008, the trajectory of the global financial crisis might have been very different. When Lehman Brothers collapsed, the immediate and obvious consequence was the panic in the market. Saving Lehman would have prevented this widespread panic that erupted after its collapse. When Lehman failed, it caused the interbank lending market to freeze. Lehman's failure caused financial institutions to become too fearful to lend to each other. A bailout or government-backed acquisition would have likely kept credit markets functioning, preventing the freeze on liquidity. Lehman's bankruptcy led the severity of the crisis to a global level. European banks were heavily exposed to Lehman's debt and derivatives. They suffered significant losses, worsening the European debt crisis. Saving Lehman could have reduced these losses and potentially slowed down the European crisis. Because of Lehman's collapse, many emerging economies experienced a sharp capital outflow. This might have been spared from the severe economic downturn they faced. As mentioned earlier, AIG was saved just the next day after Lehman's collapse. This was because people had lost confidence in the financial system and AIG was facing counterparty risk. After Lehman's failure, counterparties demanded more collateral from AIG, fearing it would be the next in line to fail. Without this panic, AIG may not have faced the same urgent liquidity crisis that required an $85 billion government bailout. If Lehman had been saved, market confidence would have been higher, reducing the pressure on other institutions like AIG. As Lehman collapsed, the government had to introduce the $700 billion TARP program. TARP means Troubled Asset Relief Program. The $700 billion for TARP was approved by the U.S. Congress in October 2008. If Lehman was saved, the need for the TARP wouldn't be so urgent, and it wouldn't have been $700 billion. It might have been around $400 billion. So overall, the government spent $700 billion on TARP plus $180 billion on AIG. So the total cost was $880 billion. If Lehman had been saved, this cost would have been much lower. Lehman would have been saved with $80 billion. If Lehman was saved, then there wouldn't have been an increase in collateral demand from AIG, so it would have been saved with around $50 billion. And the TARP would still have been needed, but it would have been around $400 billion, totaling around $530 billion, saving $350 billion of taxpayers' money. This doesn't mean that saving Lehman would have solved the underlying problem, which was the bad loans, and those loans were included in the mortgage-backed securities. This problem would have still existed, but the severity of the crisis would have been much milder. Also, saving Lehman wouldn't have caused panic in the market, which would have given the government enough time to respond strategically and saved much more damage. Before 2008, all the investment banks had done the same thing, and all of them were saved by the government. Lehman Brothers' bankruptcy case was resolved by 2018. When it collapsed in 2008, it owed over $600 billion to creditors. Over the next decade, the bankruptcy estate paid back more than $125 billion to creditors through asset sales and settlements. This is what happened at Lehman Brothers during the 2008 crisis. Let me know your perspective in the comments on whether the government should have saved Lehman Brothers or not. If you want to learn more about other aspects of the 2008 crisis, then check out this playlist where we covered everything about the 2008 crisis in detail.